Welcome to my channel. This is the chart that I use to monitor current market condition. It plots S&P 500 and Nasdaq indices with 3 indicators that I use. Are you interested to know if there are danger signs in the market currently? Are there investment opportunities right now? In this weekly market outlook video series, I will share with you my method of analyzing the market condition and how you can position yourself to remain profitable. If this interests you, stay in this video and let's jump right in. First, let's talk about Volatility Index VIX. The Volatility Index VIX is an index that represents the market's expectations for the relative strength of near-term price changes of the S&P 500 Index SPY. Volatility, or how fast prices change, is often seen as a way to gauge market sentiment, and in particular, it provides a quantifiable measure of market risks and the degree of fear among market participants. In this chart, I've plotted SPY along with VIX over the past 19 years on a monthly chart, and we can see that there were 3 instances where VIX went above 42, twice during the 08-09 global financial crisis and once during the start of COVID-19 pandemic. According to the monthly chart, when VIX went above 42, it corresponds to the SPY monthly candle before major correction. This can be used as an indication of possible market changes. Although this method is not 100% foolproof, it is useful for us to appreciate the current situation. And when combined with other indicators that I'll cover in the later part of this video, we will be able to appreciate the bigger picture better. Currently, VIX index is at 20.8 and there is no sign of any looming market correction. I would say that when VIX starts to creep above 35, we need to pay more attention to the market movement. Next, let's talk about S&P 500 Index SPY. This is the chart for SPY. There are 2 key observations here. First, the 20, 60, and 120 days moving averages representing the short, medium, and long-term price movements respectively are all moving in the 2 o'clock direction, and there is no sign of SPY slowing down. When MA20, the blue line, is above MA60, the red line, and MA60, the red line, is above MA120, the green line, they form a pattern known as the long array pattern. This is a bullish sign showing that buyers are stronger than the sellers, pushing the price and moving averages higher and higher. The converse is true. If the MA120 line is above the MA60 line and MA60 line is above MA20 line, they form a pattern known as the short array pattern, which is a bearish sign. For SPY to turn from the current long array pattern to short array pattern, or in other words, to turn from bullish to bearish, 2 things need to happen. First, the price needs to cut below MA60 line. From this graph, it can be seen that the MA60 line has been supporting the price over 6 occasions. So MA60 can be assumed, but not confirmed as the support. We need to be mindful that there is no permanent support. As the market moves, our job as investors or traders is to pick up any observable pattern and use that to our advantage. And along the way, when needed, we adapt our strategy to trade based on what we see. The second thing that needs to happen for SPY to turn bearish is that the MA20 line needs to cut MA60 and MA120 lines, like what it did in March 2020. Note, I'm not saying that SPY will definitely turn bearish or crash once they happen, but I can say confidently that if SPY is ever going to turn from bullish to bearish, these 2 things must happen. It is a path that index must take to create a downward trend, and so far we are not seeing any of these signals. Next, let's talk about Nasdaq 100 QQQ. In this chart, we can see that QQQ's moving averages are developing in a similar fashion as SPY's, in a long array bullish pattern, going in the 2 o'clock direction. As the price volatility for QQQ is larger than SPY, the support for QQQ seems more like the MA120 line rather than the MA60 line. However, I find the MA120 line a weaker support compared to MA60 for SPY, because there were only 2 instances where the price bounces off this MA120 line. So I plotted the regression trend, and we can see a clearer support at the baseline of this regression trend. If there are no major external force, for example shift in major policies changing the market direction, QQQ will tend to move in this least resistance path. Next, let's move on to a global index, MSCI World Index. The MSCI World Index captures large and mid-cap representation across 23 developed countries. With 1,557 constituents, the index covers approximately 85% of the free float adjusted market capitalization in each country. This gives us an overview of what is happening in the global markets. Similar to SPY and QQQ, MSCI World Index moving averages are in the long array pattern and has not shown any signs of turning. Next, let's talk about market risk sentiment. In this chart, the purple line is QQQ, the candles are SPY, and the blue line is the ratio of JNK over IEF. JNK is the SPDR Bloomberg Barclays High Yield Bond ETF, and IEF is the iShares 7 to 10 year Treasury Bond ETF. If an investor was given the opportunity to invest in 2 nearly identical bonds, with one bond paying 2% per year and the other paying 6% per year, logic says most would choose to invest in the higher yielding bond. In the real world, the bond paying 6% also comes with a higher risk of default. Therefore, when investors start to become more concerned about the economy and rising bonds default rates, they tend to gravitate towards lower yielding and safer bonds ETFs, such as IEF, relative to higher yielding alternatives like JNK. In other words, when the market is risk on, we will see a rising JNK over IEF graph, and if the market is risk off, more will rush towards safer bonds like IEF, causing IEF price to rise and therefore a downward trending JNK over IEF graph. You can also see that I split this graph into halves. In general, when JNK over IEF is above 0.5, we can assume market sentiment as risk on, and therefore we can see that generally SPY and QQQ are on the rising trend when JNK over IEF is above 0.5. If JNK over IEF plunges sharply below 0.5 like what we saw in March 2020 when the COVID-19 pandemic just started, we can assume that the market sentiment gravitates towards being risk off. Investors withdraw from the stock market, which will naturally cause the market to plunge. Now if I include VIX that we talked about earlier in this video into this graph, it becomes vivid that when VIX shoots above 42 and JNK over IEF falls below 0.5, something seems to be brewing in the market. Currently, JNK over IEF ratio is above 0.5, meaning a risk-on sentiment, and we continue to monitor it closely. Next, let's talk about market breadth. In this chart, the top candles are SPY, the bottom candles are QQQ, and the blue line is MMOH, and the yellow line is MMTH. MMOH and MMTH represent the percentage of stocks in New York Stock Exchange above its 100 days and 200 days moving average respectively. When I draw a line at 23 cutting across MMOH and MMTH, and draw vertical lines to the corresponding SPY and QQQ candles, you can see that they somewhat matches red candles of these indices before correction. If I put VIX, JNK over IEF, MMOH and MMTH into a single chart, it becomes very obvious. If all the 3 signals show bearish signs, that is VIX shooting above 42, JNK over IEF falls below 0.5, and MMOH and MMTH falls below 23, the probability of a market correction is high. If only 1 or 2 signals turn bearish, it might indicate a possible price drop, but the probability of a major correction is not as high. What we need to do now is to watch closely the developments of these indicators, because VIX is currently pointing upwards, JNK over IEF is hovering around 0.5, and MMOH and MMTH are pointing downwards. Now in the event that the stars are aligned and all 3 indicators show bearish signals. What do? Well, you can hit the like button and subscribe to my channel so you won't miss out on my weekly sharing. Or, there are 3 possible actions that you can take. For those who want to hedge, you can consider to initiate your hedge position. For those who want to time the market, it might be the last chance to escape. And for those whom have a longer time horizon, like 5 to 10 years for example, and if you are holding great indices and companies, you can just do nothing. Sometimes, timing the market is more important than timing the market. In the last 2 sections, let's talk about the pandemic situation and the most important parameter that all traders and investors must pay attention to: Fed's domestic market holdings. This chart shows the COVID situation in the US. The red line represents the 7-day moving average for daily COVID cases. We can see a spike in August, worsening of the situation from the trough in June, but the 7-day moving average made a turn from the August peak, hopefully towards better situation in the United States. Currently, there is no sign of pandemic being over anytime soon. The Fed continues its open market purchase amidst the pandemic situation. In this chart, the blue area represents the total amount of domestic purchase comprising US Treasury securities, Federal Agency securities, and Agency Mortgage-Backed Securities (AMBS). And they are all in an upward trend, meaning Fed is still buying. This is an important information to look at very closely because the market is artificially pushed up as Fed continues to flood the market with money. If Fed slows down the purchase, we are likely going to see market corrections as stock prices gravitate towards more realistic valuations. Meanwhile, Fed sustains its buying posture, the music is still on, and the party continues. So that's all for this week's market update. What are your views about the current market conditions? Let me know your thoughts in the comment section. If you find this video useful, please like and subscribe to encourage me to continue making such videos. Signing out, Peaceful Trader.